Welcome back to the Deep Dive. Today is Friday, February 20th, 2026. And honestly, if you're feeling a massive sense of whiplash this week, you are definitely not alone.
Oh yeah, whiplash is putting it very mildly.
Right. Normally we come on here, we look at a specific trend or maybe break down an earnings report, but this week the entire playbook just got thrown out the window.
Set on fire and rewritten overnight.
Exactly, by 9 people in robes. It has been a genuinely chaotic week.
It really has. We, in the media, tend to overuse the word historic. We say it when a new smartphone comes out or a stock hits a new high, but this week is different.
Yeah, we are watching these structural pillars of global trade shake in a way they just haven't in decades.
We have a constitutional crisis on trade policy resolving itself in real time. That is not an exaggeration.
No, it's not. The fundamental rules of how physical goods get into this country were upended by the Supreme Court. And at the exact same time, if you pivot and look at the stock market, it is flashing these wildly conflicting signals.
It's a massive tug of war.
You've got all-time high valuations on one side where everyone is partying like it's 1999. And then this deep groaning under the hood stress on the other. It is bizarre.
Think about the opposing forces here. On one side of the rope, you have this massive legal victory for importers. The Supreme Court effectively handed the economy a potential tax cut by striking down these tariffs.
Which is inherently bullish, right? Cheaper goods, better margins, simple math.
It puts money back in corporate pockets. That is a massive risk-on signal. But on the other side of the rope, we're seeing what some analysts are calling a software bloodbath.
Right, and real cracks emerging in private credit.
Yes, which has been the golden child of the financial world for 5 years now. Plus, valuations are flashing a bright red light. It's like the car engine is revving to the red line, but the check engine light is blinking furiously and smoke is coming out of the AC vents.
So our mission today is to connect these dots for you. We need to take this landmark ruling learning resources Inc. versus Trump and connect it to the gritty reality of earnings reports and hidden market leverage.
We need to figure out if this is a flight to safety or just a massive buying opportunity.
Exactly. Is smart money protecting itself, or is the fear overblown? We have the legal texts, the earnings transcripts, and the macro dashboards to make sense of it all.
It is a complex picture, but the sources lay it out pretty clearly.
They do. But before we dive into the legal drama, just a little housekeeping, we are going to be talking a lot about market temperature and valuations today. We are going to throw around some numbers, specifically something called the Buffett Indicator.
Which is crucial to understand right now.
It really is. So if you want to track the total market temperature we discussed today, you need to grab the Buffett Indicator app. Just search for Buffett Indicator on the Apple App Store and download it.
It's a great tool. It visualizes the exact data we are going to be breaking down later.
Yeah, it helps you see if the market is overheating or freezing over right on your home screen. Search it, download it. And as always, a quick disclaimer, full deep value research reports are in the description links.
All the analysis today is based on publicly available sources and is subject to revision or differing interpretations.
Exactly. All content from this channel is for educational and research purposes only. It does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
Markets are incredibly volatile right now.
Very. And if you want to access more advanced content, you are welcome to subscribe on deepvalues.ai. We share our latest research and the most advanced AI agent tools for our contrarian friends over there.
It's a great community.
And don't forget to like this content. We really appreciate it. Okay, let's unpack this Supreme Court ruling, because this wasn't just a little slap on the wrist for the administration.
No, this was a sledgehammer.
Let's talk about Learning Resources, Inc. versus Trump. The verdict came down this morning.
A 6-3 decision striking down the administration's use of the International Emergency Economic Powers Act, or IEEPA.
Right, the IEEPA.
They used it to impose massive tariffs. This has been the cornerstone of the administration's trade policy for over a year, using emergency powers to bypass Congress entirely, and the court just said stop.
I really love the David versus Goliath aspect of this case, because when you think of who takes on the President of the United States on global trade policy, you think of massive conglomerates.
Expect Apple. You expect General Motors.
Some Fortune 500 company with 1,000 lawyers in $5,000 suits.
You expect the K-Street lobbyists to be leading the charge.
But it wasn't. It was Learning Resources and Hand to Mind. These are family-owned educational toy companies from Vernon Hills, Illinois.
It's incredible.
They make those little coding robots for preschoolers and plastic counting blocks.
And that is exactly what makes this so significant. These weren't multinational corporations trying to protect a billion-dollar executive bonus pool. These were mid-sized companies facing what they literally called asphyxiation from duties.
Asphyxiation. That's a strong word for illegal filing.
Their CEO, Rick Woldenberg, was very vocal about this. We aren't talking about a margin squeeze of a % here or there. They were dealing with stacking tariffs.
Explain stacking tariffs for a second.
Well, they had the reciprocal tariffs, and then the trafficking tariffs were piled on top of those. It was completely wiping out their entire business model.
So they were getting taxed multiple times on the same plastic blocks.
Exactly. They were facing annual tariff bills of $14 million that they had not planned for.
$14 million for a mid-sized family business is lethal. That isn't a line item on a spreadsheet. That is the entire budget.
It is an absolute death sentence for a business that size. So they argued that the president simply didn't have the authority to do this under the 1977 emergency law.
They basically said, look, this law is for freezing the assets of terrorists or sanctioning rogue states. Yeah. Not for taxing plastic toys from China just because you don't like the trade deficit.
And the Supreme Court agreed with them.
The legal argument here is truly fascinating. Chief Justice Roberts wrote the opinion, and he got incredibly textualist on this. It wasn't about the broad politics, it was about the literal grammar of the statute.
He did. It all came down to the definition of the word regulate.
Right.
The IEPA says the president can regulate importation. The administration argued that the power to regulate importation naturally included the power to tax it via tariffs.
But the court said no.
Roberts pointed out that in the actual text of the statute, the words regulate and importation were separated by 16 other words.
16 words. That is such a specific legal detail to hang a $1.4 trillion economic policy on.
It is, but in textualist law, those gaps really matter. The court ruled that you cannot hide a massive tax increase in the gap between those words.
Right.
They said if Congress wanted to give the president the power to explicitly tax, they would have used the word tax or duty or tariff. They didn't.
So this ruling essentially reclaims the power of the purse for Congress.
It is a massive reassertion of the major questions doctrine. That's the idea that if an agency or the president wants to do something with vast economic significance, they need clear, explicit permission from Congress.
Which they didn't have here. So practically speaking, for the broader economy, this is just a giant tax cut. We can call it a legal ruling, but economically it is a tax cut.
A truly massive one. Analysts at Morgan Stanley and BNY are viewing this as a huge disinflationary event.
Because you were removing tariffs that were effectively just a consumption tax.
Exactly. When you tax an import, the cost of that tax eventually lands on the consumer, or it eats into the retailer's margins. Removing it lowers the landed cost of goods immediately.
So let's talk winners.
Yeah.
Who is popping champagne today? Because the market reaction was very specific.
The list is extensive, but you really have to start with the giant retailers: Target, Walmart, Costco.
Especially Costco.
Yes, Costco was actually a combatant in these lawsuits. They were actively fighting alongside the toy companies.
Which makes sense when you think about Costco's business model. They operate on razor-thin margins, maybe 3.8 to 4% on a good day.
Right. They make their money on volume and membership fees. They simply do not have the room to absorb a 10 or 20% cost hike without passing it directly onto the consumer.
So if you suddenly remove a 10% tariff cost from their supply chain that is transformative for their bottom line,
it changes the math of their entire fiscal year. It allows them to either keep prices low, which gains them even more market share, or they can expand their margins and pay out bigger dividends.
And I saw the toy industry is breathing a massive sigh of relief, too.
Huge relief for Mattel and Hasbro. They have about 80% industry exposure to China right now.
Why is it still so high? I thought companies were moving away from China.
The toy industry is still heavily concentrated in Asian manufacturing because of the sheer complexity of painting and assembling tiny plastic parts.
Yeah.
It's hard to replicate that ecosystem quickly. And they were looking at stacking tariffs that could have reached 145% on some items. That threat is now gone.
145%. That isn't a tax, that's a prohibition. You cannot sell a Barbie doll if the tax is higher than the manufacturing cost.
You really can't. And that's exactly why the court stepped in. You also have the apparel sector. Nike stock popped 4.4% on the news. Ralph Lauren was up too.
These are companies with incredibly complex global supply chains that were just getting tangled up in these emergency orders.
And importantly, the auto sector. We have to talk about the auto sector.
Trafficking tariffs.
Yes, the administration had placed tariffs on Mexico and Canada, citing trafficking as the national emergency. This was absolutely hammering the North American auto supply chain.
Because a car part might cross the border 3 or 4 times before the vehicle's actually finished, right?
Exactly. Every single time it crossed the border, it was getting hit with a tariff. Those are gone now. Toyota and the integrated North American supply chain were getting crushed. But now that integrated system survives.
But here is where it gets really, really messy. The refund battle.
Oh, yes.
Because companies have already paid billions in these tariffs throughout 2025. Can they actually get that money back?
That is the multi-billion-dollar question right now. We are talking about potentially $200 billion in duties that were collected under what the Supreme Court has now officially said was an illegal authority.
$200 billion.
Yes. Corporations are currently trying to claw that back. It is creating an absolute legal nightmare. And it's not just private companies, by the way.
Well,
States, Oregon, Arizona, Connecticut, they all joined the suits because they were paying these tariffs on public procurement.
oh, wow. So when they were buying goods for schools or hospitals or infrastructure,
Yeah.
they were paying the illegal tax too.
Exactly. So the Treasury might literally have to cut a check for $200 billion to refund everyone.
That is a massive fiscal hole. If the Treasury has to refund that money, we could see a real spike in bond yields because they would have to issue more debt just to pay for the refunds.
The government already spent that money. It's gone. And there is a real moral dilemma here, too, which a lot of experts are pointing out today.
What's the dilemma?
Well, the corporations might get the refund. Target, Costco, Best Buy, they might get a massive check from the government. But you and I,
The consumer.
the consumers who actually paid the higher prices for sneakers and electronics all through 2025, we are not getting a rebate check in the mail.
Right. We paid the higher retail price. The company paid the tariff. Now the company gets the tariff money back, but we don't get the price difference back.
Exactly. It's essentially a corporate bailout via the Supreme Court. That is going to be a major talking point.
I can literally see the headlines now. But okay, the administration didn't just take this lying down. The ink wasn't even dry on the ruling before Plan B came out.
It really is like a game of legal whack-a-mole. Welcome to Section 122.
Okay, break down Section 122. This is the Trade Act of 1974, right?
Yes. The administration immediately pivoted to Section 122 of the Trade Act of 1974.
How is this legally different from the Emergency Act they just lost on? Why would this one stick if the other one was struck down?
The language is much stronger. Section 122 explicitly mentions the word duties. It allows the president to impose duties to address large and serious balance of payments deficits.
And the U.S. obviously has a trade deficit, so the factual predicate is there.
Exactly. Legally, it is on a much firmer ground because Congress actually wrote the words, you can impose duties for the specific reason. They didn't have to jump through the regulate importation hoop.
Okay, so are we just back to square one then? The tariffs are just back under a different name?
Not exactly. There is a crucial detail here, a massive catch. Section 122 has a 150-day hard limit unless Congress actively votes to extend it.
Ah, okay, so it's a ticking clock. It's temporary.
Precisely. It's a temporary power intended to give Congress time to act. And this introduces a huge issue for the market, which we call the uncertainty premium.
Because if you are a business trying to plan your year, do you reroute your entire supply chain for a tariff that might just disappear in 5 months?
Exactly. It takes way longer than 5 months to move a factory out of China. It takes longer than 5 months just to negotiate a new vendor contract sometimes.
Right, so companies are just frozen. Do they pay the new tariff? Do they raise prices today? Or do they eat the cost and just pray it expires in 150 days?
They are completely paralyzed. And think about the political reality here. We have midterms coming up. Is Congress really going to vote to extend a tax increase on their constituents right before an election?
It's a massive gamble for the administration to rely on Congress to bail them out here. So it's basically a game of chicken between the president and Congress now.
Yes, it is. But we have to be clear for you listening. Not all the tariffs are gone. There is bad news, too.
What survived the ruling?
Section 232 tariffs, those are the ones on steel at 25%, aluminum at 10%, and the tariffs on semiconductors. Those all remain active.
Why did those survive if the others didn't?
Because they are legally based on national security, not an international emergency, the legal justification is completely different. The Supreme Court ruling today didn't even touch Section 232.
So the cost of building a skyscraper or making a car chassis is still going to be high?
Yes. And the China tech tariffs under Section 301 also remain.
So there is this weird nuance now. If you are Apple, you get relief on your accessories because those were taxed under the Emergency Act.
But the actual semiconductor chips inside the phone, those are still taxed under Section 232 or 301. It's a highly fragmented patchwork landscape now.
So big picture on the trade war. The Supreme Court killed the broad sweeping emergency tariffs. The administration is trying to revive them with a 150-day timer. And the specific tech and metal tariffs are staying exactly where they are.
That is the perfect summary. It's chaos, but it's a very different kind of legalistic chaos than we had yesterday.
Okay, let's pivot to the markets. Because you would think with a massive tax cut from the Supreme Court, the market would be ripping higher across the board today.
You would think that.
If Costco's getting a refund, Costco's stock should fly. And it did a bit. But the broader market is acting really weird.
It is acting very weird. And this brings us to the insights from Steve Eisman's latest weekly wrap.
Eisman is the guy who famously bet against the subprime mortgage market, right? The big short guy.
Yes. And he is seeing something very specific right now. He calls it a flight to safety, but wrapped in an illusion.
I read that report. He calls it the flat market illusion.
Right. If you just look at the S&P 500 year to date, it looks totally flat, boring even, maybe up 1%, down 1%. But under the hood, there is a violent rotation happening.
A rotation from what to what?
Investors are moving rapidly from performance chasing, which basically means buying whatever is going up, usually tech, to a desperate flight to safety.
The stats he pulled to prove this were wild.
They are very telling. The S&P 500 infotech sector is actually down 4% year to date. That is the engine of the entire bull market, and it's sputtering.
But the S&P 500 staples sector toothpaste, toilet paper, groceries is up 13%.
But wait, didn't we just establish that staples have been struggling with inflation and these exact tariffs?
That is the massive irony here. Eisman points this out explicitly. The actual fundamentals of the staples sector aren't better right now.
They are hurting from the same inflation, the same labor costs, the same supply chain issues as everyone else?
Exactly. But investors are scared. They are hiding in staples because they perceive it as safe. They think, well, people always need toothpaste, even if there is a recession.
So they are completely ignoring the underlying valuation and the poor earnings growth and just blindly buying the category.
It's essentially panic buying, but for stocks. It's like buying all the toilet paper during the pandemic. You don't actually need that much toilet paper, but it feels really good to have it in the closet.
That is a perfect analogy. And while they are panic buying staples, they are dumping software. Eisman calls it the software bloodbath.
The software subsector is down 20% this year alone.
20%. That is a full-blown bear market just for software companies.
It is. And it's largely driven by AI fears. The idea that AI agents might just replace traditional SaaS companies entirely. Plus, there's just general valuation compression happening. We are firmly in a bad news cycle.
Explain the bad news cycle for us. What does that actually look like day to day?
Well, in a raging bull market, stocks go up on good news. And they mostly ignore bad news. They just shrug it off. But in a nervous market, stocks go down on bad news. They go down on mixed news. And sometimes, and this is the really scary part, they even go down on good news.
He gave the example of Palo Alto Networks, right?
Perfect example. Iconic cybersecurity company, best in breed. They reported their earnings. Revenue grew 15%, which beat expectations. EPS grew 27%, which also beat expectations.
That sounds incredible. That's a double beat. The stock should pop on that.
The stock dropped 6%.
Why? If they beat on top and bottom lines, why did it drop?
Because of mixed guidance. The future outlook looked a little less than perfect. In this current environment, good simply isn't good enough anymore. You need perfect. And if you aren't perfect, the algorithms just sell you.
And we have NVIDIA coming up. That is the massive elephant in the room right now.
The biggest one. The expectation is that NVIDIA will report absolutely massive numbers. The hyperscalers, Meta, Google, Amazon, Microsoft, they have all announced they are spending $650 billion combined on AI CapEx in 2026.
$650 billion. That is an insane number. That is larger than the GDP of most countries.
It is. And a huge chunk of that is going directly to buying NVIDIA chips. So NVIDIA should, by all accounts, report incredible numbers. But the fear in the market is, will it even matter?
If Palo Alto beats and drops, what happens if NVIDIA beats and just stays flat? Or worse if it drops?
If NVIDIA drops on spectacular good news, the psychological impact on the broader market will be devastating. It would be a major signal change.
It would essentially mean the AI trade is exhausted. And speaking of signals, let's talk about the consumer. Because even the safe havens are showing real cracks under the hood.
Like Walmart.
Walmart is the most fascinating case study right now. They just reported earnings. They beat on EPS and they beat on revenue, but the guidance was genuinely weak.
They guided for $2.80 EPS versus an expected $2.96. That is a significant miss on their future outlook.
So the consumer is weakening. Walmart sees the credit card data first. If Walmart says the consumer is weak, the consumer is weak.
Yes, but look at their valuation. This is the crazy part. Despite the weak guidance, despite the slowing growth, Walmart currently trades at a 50 times PE ratio.
50 times earnings. For Walmart, that sounds like a dot-com tech stock from 1999 or Tesla in 2020. Walmart is a grocery store.
It's wild, and Eisman asks the obvious question, why? Why would anyone pay 50 times earnings for a retailer that is growing its EPS at 6%?
It has to be scarcity, right? Scarcity value.
Exactly. There are so few survivors left in the retail sector that investors are just piling into the ones that are left standing and bidding the price up to the moon.
They look at Target struggling, they look at department stores dying, and they say, Walmart is the only one left I have to own it regardless of price.
It's the safety trade becoming a massive bubble in and of itself.
That is a terrifying thought, that the safest place in the market is actually the most expensive and potentially dangerous place.
It's like running into a burning building just because it's the only building left standing on the block.
It's a classic late cycle phenomenon. Investors crowd into the few things that are still working until they become so crowded and expensive that they stop working.
And then you have the complete opposite end of the spectrum. Carvana. The ultimate meme cult stock.
Carvana is fascinating. They missed earnings. They gave incredibly vague guidance. The ultimate trifecta of bad news. The stock dropped 20% after hours.
Which makes sense.
And then it rallied all the way back the very next day. It ended the day down only 8%.
How does that even happen? Why?
Short covering. Pure market mechanics. So many people are betting against Carvana that when the stock drops 20%, the short sellers decide to cash out and take their profit.
And to take profit on a short position, you have to actually buy the underlying stock.
Exactly. That forced buying pressure pushes the price right back up. It keeps the zombie company alive.
So fundamental business metrics don't matter for Carvana because of short squeeze mechanics. And fundamentals don't seem to matter for Walmart either because of blind fear and scarcity.
It is a completely disconnected market right now. And historically, that usually happens right before something major breaks.
Speaking of things breaking, let's move to section 4 of our deep dive. The hidden risks. Because Eisman flagged two things that sound like literal ticking time bombs.
And nobody is really talking about them on the front pages yet?
They never make the front page until they actually explode. The first one is private credit.
We have heard about private credit constantly for years now. It has been the golden child of Wall Street. The narrative is always, banks aren't lending anymore, so private equity will step in and save the day.
And they have. But major cracks are forming. There was news this week about Blue Owl restricting withdrawals from one of its major private credit funds.
Restricting withdrawals is never, ever a phrase you want to hear as an investor. That gives major Hotel California vibes. You can check out anytime you like, but you can never leave.
Exactly. The underlying mechanic here is something called a duration mismatch.
Break that down for us. What is a duration mismatch?
Okay, so you have retail investors, regular, everyday people who put their money into this private credit fund. They are promised they can get their money out on a quarterly basis.
So to the retail investor, it feels like a liquid asset. I can get my cash in 90 days if I need it.
Right. But the fund takes that cash and lends it to mid-sized companies for 5, 7, sometimes 10-year terms. Those are highly illiquid long-term loans.
You can't exactly just call up a manufacturing plant and say, hey, pay me back that 10-year loan today. I need the cash.
You can't. So if everyone wants their money back on a random Tuesday,
the fund physically cannot call the loans back. They simply do not have the cash on hand to pay the redemptions.
It's a classic bank run.
Essentially, yes.
Yeah.
Eisman compares it directly to the savings and loan crisis of the 1980s. It works beautifully on paper until everyone heads for the exit at the exact same time. Then the doors just lock.
And Blue Owls is just one fund. If this starts happening across the entire sector,
it becomes a systemic issue. If retail investors lose confidence in private credit broadly, they will all pull their withdrawal requests at once. The funds will have to gate the withdrawals. Then pure panic sets in.
It's a liquidity crisis in a sector that has grown massively in the shadows over the last decade.
And then there's a second risk he flagged, life insurance.
Life insurance sounds incredibly boring. It is supposed to be the most boring, heavily regulated industry on Earth.
It used to be. But Eisman thinks there is a massive potential problem brewing right under the surface.
Why would change?
Private equity involvement again. PE firms have been aggressively buying up life insurance companies.
Why do they want life insurance companies?
Because they want the float, the premiums that regular people pay every month. It is essentially permanent capital. They take that massive pool of money and they invest it.
Invest it in what, though?
That is exactly the problem. Traditionally, life insurers invest in very boring government bonds, highly safe, highly liquid. But PE firms are moving that float money into riskier, higher leverage investments.
Often into their own private credit deals, right?
Yes, to juice their returns. Eisman is warning about hidden leverage and potential asset stripping in the industry.
So grandma's boring life insurance policy is suddenly backing a highly leveraged buyout somewhere or a risky commercial real estate loan.
Potentially, yes. It introduces a massive amount of risk into a sector that is fundamentally supposed to be risk-free.
If a major life insurer stumbles because of a bad private credit investment, That is a whole different level of panic than a tech stock dropping.
Oh, absolutely. That hits pensioners. That hits the real everyday economy.
It feels like there are landmines everywhere you step right now.
It's a complete minefield. You have to step very carefully.
Okay, so we have the trade war chaos, the market rotation into staples, and these hidden credit risks. Let's look at the actual dashboard. We have data from the Druckenmiller dashboard.
This is the objective mathematical look at things.
Right. What is the actual temperature of the market right now, objectively?
So looking at the dashboard, the total risk score is a 10 out of 20. That puts us squarely in a neutral risk regime.
10 out of 20 sounds fine. Like, perfectly average.
On the surface, yes, it sounds fine. But you have to look at the underlying components. It is a mix of bright green and flashing red. It is not a calm 10. It is a highly chaotic 10.
Let's start with the red flags.
Valuation. It is screaming red. The Buffett Indicator, which is the total stock market capitalization divided by the U.S. GDP, is currently sitting at roughly 221%.
221%?
Yes. For context, historically, anything over 100% was considered high, 120% was considered a bubble.
So 221% implies the market is priced for absolute perfection. It implies that future corporate earnings will be astronomically high.
And again, if you want to track that specific number yourself, download the Buffett Indicator app on iOS. It is crucial to see how that trend line has moved over time.
Yeah, seeing it visually on a chart really helps you realize how far above the historical norm we currently are. It's very sobering.
Absolutely. And it's not just the Buffett Indicator flashing red. The Shiller Key PE ratio, which is the cyclically adjusted price-to-earnings ratio, is hovering around 39 or 40. That is well above long-term averages.
So stocks are expensive, historically wildly expensive. If you are buying the market right now, you're paying a massive premium.
You are. And here's where the tension comes in. The liquidity signal is green.
Meaning there is still plenty of money sloshing around the system.
Exactly. The Chicago Fed National Financial Conditions Index is actually negative right now, which means conditions are loose, easier than average. Money is freely flowing.
Banks are still lending, mostly.
Right. And credit spreads, the difference between safe government bonds and risky corporate bonds, are very tight. That's a yellow signal. The bond market simply isn't panicking yet.
So we have a market that is incredibly expensive on the red side, but the money is still free-flowing on the green side.
That is exactly how you get a neutral 10 score. It's a total standoff. Valuation says sell immediately, but liquidity says keep buying.
Eisman had a really interesting take on this tension. He talked about why we haven't crashed yet. Why hasn't gravity taken over when valuations are this high?
He believes retail investors have been perfectly trained, Pavlovian style.
By the dip.
Exactly. For the last 15 years, essentially since the 2009 financial crisis, every single time the market dropped, if you bought the dip, you made money.
Every single recession fear turned out to be a false alarm.
Right. So retail investors have learned a very deep lesson that fear equals opportunity.
So they just keep buying regardless of the news.
They keep buying. Eisman's core argument is that the only thing that will ever break that ingrained habit is a real structural recession.
Not just a slight slowdown or a soft landing.
No, a real painful recession where buying the dip actually leads to losing your money. When you buy the dip and it just keeps dipping, that is the only thing that breaks the psychology.
And are we there yet?
He says not yet. GDP is technically still growing. We have this K-shaped economy where the wealthy are doing completely fine and the lower income brackets are really struggling, but the aggregate macroeconomic numbers are still holding up.
So we are just stuck in this weird limbo, waiting for the shoe to drop, but the music's still playing so people keep dancing.
Limbo is the perfect word for it.
So let's try to bring this all together for the listener. We started with February 20th, 2026 being a historic week.
It really is a perfect storm of conflicting economic currents. You have the Supreme Court acting as a massive unexpected stimulus by removing tariffs. That is a clear win for retailers, automakers, and consumers.
That is a tangible positive. But then you have the administration countering with Section 122, adding that thick layer of uncertainty right back into the mix. The tariffs are gone for now.
And beneath all of that political drama, you have a market valuation of 221% on the Buffett Indicator that says we are in a historic bubble.
While sectors like software and private credit are starting to show signs of rotting from the inside,
it really feels like the era of easy money might actually be over.
I think that is the key takeaway for you listening. The era of buy anything and it just magically goes up is gone. We are firmly in a stock picker's market now, or perhaps a stock avoider's market.
You have to be incredibly wary of companies giving mixed guidance, like Palo Alto did. You have to carefully watch that 150-day clock on the new Section 122 tariffs.
And most importantly, you have to question the absolute safety of the safety trade itself.
That is the final provocative thought I want to leave everyone with today. Everyone is rushing into Walmart and Staples because they are terrified of tech and AI replacing software.
But if safety means paying 50 times earnings for a grocery chain that is only growing at 6%, is there actually any safety left in the market at all?
Or has the lifeboat itself become the most dangerous place on the entire ship?
Exactly. When the entire crowd all runs to one side of the boat at the same time, that is usually exactly when it tips over.
That is a very cheerful image to leave us with today.
Well, I try my best.
Yeah.
But seriously, thank you for breaking this all down. It is a massive amount of complex information to digest.
Always a pleasure to dive into it.
Before you go, a final reminder for everyone listening. Knowledge is power, but actual data gives you clarity. Download the Buffett Indicator iOS app to keep a close eye on that 221% number we talked about.
It might just be the single most important notification you get on your phone this month.
And remember, this discussion was for educational purposes only. Do your own due diligence. Don't just blindly follow the herd into a crowded trade.
And for the true contrarians out there, the ones who want to see exactly what the AI agents are seeing, subscribe to deepvalues.ai.
We will see you all in the next deep dive.
Stay curious.